imagine you own real estate in over 100 cities across the globe, generating billions of dollars just for you. How would you feel? And what would you do with all that money? This was the story of WeWork, the office space company that used to give away unlimited free beer. One day, WeWork was at the top, and then boom, they went bankrupt, killing a real estate business that was once valued at $47 billion. And today, we're gonna learn what went wrong and what you can do differently so you don't become the next WeWork. Before we start, let's first learn about WeWork. Aside from the free beer, who are they and why should you care? To do this, we're gonna take a look at our blog, courtesy of NovaRice. So here's the blog article and our NovaRice website. For those who want to read it on your own, the link is down in the description box below, and you will also find it down in the comment section below. So, like I said, who's WeWork? So WeWork was a new and promising American startup that quickly went viral in a good way, revolutionizing the commercial real estate market. The man behind this is Adam Neumann and his wife, Rebecca Keith, and Miguel McKelvey. Neumann and McKelvey established Green Desk, an eco-friendly co-working space in Brooklyn in 2008. This was like their first step, a warm-up for the big leagues. And after they sold Green Desk, they put everything into WeWork, setting off a journey that will take them to the heights of success. Now, I want to take a pause here and just make sure I address this. I know commercial real estate is not doing so well right now, but remember the real estate market is cyclical. They might not be doing well today, but they could be doing great tomorrow. So learning about cases like this will help you better prepare for the future instead of waiting until the problem shows up in your face and then trying to figure out what to do. Now, back to the article. How was their business model? So the way WeWork worked is that they started renting out office spaces and co-working areas to businesses on flexible terms for a short period. But here's the catch. WeWork didn't own those spaces. They were tenants themselves, subleasing to others. Now, how did they make money? Well, the answer comes down to the classic buy low, sell high strategy. The startup rented the premises, cleaned them up, provided all the work essentials, and rented them out at a slightly higher price. It was very convenient for the clients to rent spaces with excellent and comfortable working conditions. Everyone was benefiting in this story. The startup's idea resonated with consumers, and very quickly, WeWork found its way to expanding worldwide. By 2021, the company already had 764 co-working locations in over 100 cities across the globe. Can you believe that they were managing about 15 million square feet of space, from large business offices to cozy co-working spots for freelancing or small groups? WeWork offer it all. And here's a nice map that you can check out showing all their locations worldwide. They were pretty big at the time. Back then, WeWork had grown to around 490,000 members, and almost half were corporate clients. WeWork quickly became one of the most expensive U.S. startups, reaching over $47 billion in value. They got a 1.7% share of the global service office space market in 2019. Which was more than a significant achievement for an ambitious and fast-growing startup. And as you can see here is where WeWork is located. Not bad for a startup. They have quite a market share for such a new company. But here's the big but. WeWork's story isn't all about success. Recently, WeWork reported total debt of $18.65 billion against total assets of $15.06 billion in an initial filing. That means they were in the negative at that point. And yeah, the situation to be better, but what led to this? Well, this is what led to it. Let's learn about this, right? First, there was ineffective corporate management. Central to WeWork fall is Adam Neumann and his Game of Thrones level of control. He held the reins over the board, made all the major calls and decisions, controlled the fate of the shares, and even planned for his wife, Rebecca, to step in as the next CEO after him. That's a ton of power in one person's hand. But things don't end there. WeWork's original plan didn't involve buying real estate. It was about renting spaces cheaply, renovating them, and leasing at higher prices. Neumann, though, thought to squeeze the most out of his startups, and he brought properties himself and then rented them out to WeWork. Essentially, WeWork was paying him rent and for his loans, plus regular revenue from the businesses. I mean, talk about a conflict of interest, right? Then the next problem was they were actually caught up in a lot of debt. The irony was that with WeWork, the more money WeWork made, the more they spent. A huge 65% of their spending went on rent. This is normal for a company expanding in commercial real estate, but it was growing too fast. After all, the profitability of existing outlets was not enough to cover the cost of opening new ones. Thus, the debt of WeWork grew like a snowball, becoming too big for investors, the board, and management to ignore. And just a caveat here, and you can see this in the blog as well, taking too much debt is nothing new for real estate. This WeWork example actually slightly resembles Evergrande's case, the Chinese real estate giant that accumulated over $300 billion in debt and created many issues far beyond China. And I actually created an episode about this. If you're interested, feel free to check it out after you're done with this episode. Another issue WeWork was facing was the shifting focus and workplace culture issues. So according to former employees, WeWork internal atmosphere was far from being perfect. Let's start with the board of directors, right? Until 2019, not a single woman had a seat. Frances Frey was the first, and her appointment seemed timed with WeWork's attempt to enter the stock market, especially since having a female board member was the norm for S&P 500 companies. Then there was the culture. WeWork had an interesting way of rewarding employees and clients. Free beer and wine right in the office. While this might sound fun, it wasn't always great for maintaining a professional work environment. And I'm sure a lot of you agree with that. By the way, many businesses, including tech startups, practice the so-called happy hour. This is when, on certain days, employees can discuss work issues in a non-work environment over a glass of anything. And this can work well if it's an occasional thing. Yet, if you flood the office with unlimited free alcohol, as was the case with WeWork, it is unlikely going to do any good. Another problem they were dealing with was the pandemic renting collapse. We all know what happened. The pandemic hit. A lot of people were working remotely, so less need for office spaces. In fact, here is something interesting that the Nova Race team created that I wanted to share with everybody. Even before COVID-19, about 56% of global jobs had tasks that could be done remotely. And when the pandemic struck, many lost or changed their positions to home working. Survey shows that 55% of them see no difference in office and remote effectiveness. And 90% of remote workers want to keep it that way. In fact, if you look at this graph right here, courtesy of Gallup, you will see that a total of 55% of workers were just as productive. So when you take this into consideration and you bring it to the bigger picture, it's actually better for companies because if employees can stay at home and just be as productive, then big companies get to save money on the rental of their office spaces. And that, in fact, will translate to more revenue for the company because now they don't have to pay those expensive leases. Now onto the important facts. I know that commercial real estate is not doing well, but what can we expect in the American real estate sector for the future, especially in the commercial real estate space? Well, for starters, COVID-19 is now a thing of the past. However, many real estate leasing firms are still feeling its aftershocks. It is too early for the commercial real estate space to relax, according to the team who created this blog. The pandemic era introduced many to the benefit of remote work, and employees enjoyed the flexibility and companies saved on office rent, like I mentioned before. In 2022, this shift led to a nearly 6% drop in rental values in the US. This is on the commercial space side. And it's not just an American trend. Everywhere from San Francisco to Hong Kong, leasing businesses in major cities worldwide are feeling the pinch. And we can actually take a closer look at this in this graph. So here we are. Office space lease, a drop of 5.7%. And the big winners are everyone in the apartment, hotel, and industrial sector. And we're going to get back to this in a few. And just to give you a point of comparison, as of Q1 2023, only 860,000 square feet of office space were leased in San Francisco, while pre-pandemic in 2018, this number was nearly 3 million. That is a big drop in there. And then to make matters worse, in early 2023, San Francisco-based tech giant Dropbox reported a huge loss of over $175 million due to unused office space they wanted to sublease. And other big names in the city like Airbnb, Twitter, and Uber Technologies have also faced cutbacks. Airbnb let go of about 25% of its workforce in 2020, while Elon Musk slashed Twitter's workforce by 80% in less than a year. And this is not just a Silicon Valley issue. Only about half of New York City office workers have returned to their desk, and many buildings struggle with lost tenants and the need for overhaul. And another 290,000 square feet of office space were left empty in downtown Atlanta at the beginning of 2023. Have you ever heard of the saying, when it rains, it pours? Well, this is exactly that. So now on to the lessons. What lessons can we learn from this? So for leasing firms, the drop in demand for commercial real estate, it's loud and clear. We get that. But one of the possible ways to solve this problem is to rent out all these premises for events, trading areas, or even warehouses. Yet it's not a fix-all solution. The market still has its limits, but it is something to consider. Another idea is turning office spaces into residential premises, but that involves a significant time and money, which is a tough call for companies on the edge of bankruptcy. And sometimes selling these properties before they lose more value and investing elsewhere might be the smarter move. I want to hear about this. What do you think? Do you think that the suggestion made by the NovaRise team is actually a good way to go about it, or do you have a different approach? Let me know down in the comments. And now for banks, the situation promises troubles for banks because they're actively crediting this industry. And here are a few facts that you should take into account. 55% of U.S. loans are on banks' balance sheets. For instance, Signature Bank had the 10th largest commercial real estate loan portfolio in the U.S. at the beginning of this year. And regional banks, they make up 23% of the total. And they're also feeling the pressure as well. So if their borrowers default, these banks could face the risk of going under as well. As for investors, caution is key. The WeWork story teaches us to look beyond a company's success. High returns can be tempting, but every investment has its risk, like the unforeseen hit of a pandemic. So where should you go from here as an investor? There's no crystal ball. We shouldn't panic just yet, but the road of stability will be bumpy, requiring tough decisions, compromises, and smart strategies. That's why the best universal investment is in your knowledge. That way, you don't become the next WeWork and risk losing a $47 billion valuation. See you in the next video. Bye-bye.